Okay, everyone, thanks for joining us here today. We're starting something new here at Superform. We're calling it Where Does the Yield Come From? On Superform, we have over 800 different yield opportunities across 10 different chains available currently. And we wanted to take this opportunity to start highlighting some of the awesome yield that we offer and getting some of the team members from the protocols that are featured on Superform and getting you guys up here to talk about what you're building and where does the yield come from. So would love for you guys to introduce yourself. Let's start with Ivan from Resolve Labs. So Ivan, can you tell us a little bit about your background and what brought you here today?
Sure. Thanks a lot for having me here today. I'm actually I was supposed to work on nuclear reactors and stuff as an applied physicist back in the day, but instead of that, I went to work on other weapons of mass destruction, as some people call them, derivatives. So I worked in finance for more than 10 years, initially hedging large corporates from different types of risks, FX, rates, credit, commodities, and later shifted into building structured products, structured investment products desk. So worked a lot from different angles on these types of instruments, from like economical perspective, operational, regulatory, and all this stuff. So I'm a TradFi guy, if you think of it. I transitioned full time into crypto in early 2022. Perfect timing, I'd say. Right after the highs of the market, advised some projects, and later went on to create what is now called Resolve Labs. Basically, yeah, we started when USDC depegged back in March 2023. We're thinking, hey, maybe there potentially could be some good solutions to have a decent yield and a peace of mind in terms of stability. And that's what got us started in the first place.
Awesome, thank you. And excited to dive into Resolve and what you guys are building. But let's turn it over to Jorge now. Can you tell us about your background and everything that you're working on and how you got started with Max APY?
Sure. First of all, thanks a lot for organizing this space and having us. My background is in basically entrepreneurship. I've started several startups. First one was in recruitment. We sold that one, started one in AI, then also built one in esports, which we IPO'd on the Toronto Stock Exchange in 2021, and that was basically, well, I've been also been in politics. I've done a few boards of a few tech companies, and in 2021 was when I decided to go full-time crypto. I've been investing in crypto since 2012, and that's when we started first with Unlocked, which is a real world asset collateralized lending protocol. And then we evolved that into a venture builder called Veris Labs, which is where we have developed Max APY. And I also manage a couple of crypto hedge funds out of Luxembourg. And on Max APY, we basically built it because it was solving a need that we ourselves had. So I love DeFi. I've been very deep into DeFi, into very much like degen plays and stuff like that. But my issue has always been time. If you want to do DeFi properly, it's a full-time job, and it's not 8 hours per day. It's 24 hours per day if you want to do it properly. And so I thought, when what I do is it is automatable. So why don't we build something that automates the stuff that I or other degens do, to ensure that you can always get the maximum possible APY, hence the name, on your ETH or on your stable coins. And that's how it was born.
Cool. Yeah, I'm totally relate and resonate with that. Superform was created for a similar reason. Like you say, DeFi and being like maximally efficient in DeFi just takes so much time and effort to really maximize your returns. And we kind of came at it from a different way, trying to improve the user experience and the accessibility. But when we're relying on guys like you for this like automation component and just having these like super easy to access yield strategies. And I love how both you guys have these diverse backgrounds, even as diverse as working on nuclear reactors or politics, and yet all roads lead to crypto at the end of the day. So let's
Yeah,
start to dive into.
it's kind of the it's kind of like the first place where, even though I've worked again like politics and tech, it's the first place where I'm like really super proud of what we're doing, because everything you do here feels like you're working towards a larger goal that is good for everyone. So yeah, it's definitely special to be here.
Yeah,
Is it
you,
different in politics? I
I
wonder.
was going to answer the question.
That feeling.
It's the goal is not different, but definitely. I mean, I was in politics, kind of like on the side, so it was like my main thing for sure. But there, you definitely feel like you're making very little progress. So here, at least, you feel like you are actually being productive about that goal.
Yeah, I mean, crypto moves a little bit faster than politics, I imagine.
Oh yeah, it does.
Oh, I love that insight. Let's turn it back over to Ivan. So I want to dive into Resolve USR, your stable coin, because it's pretty unique in the way that it functions, um, and is providing like really good yield from what I see on Superform. And I would love to understand, like the mechanism of how that works in your own words, and how users are able to earn these high returns from this stable coin, and what you like ultimately envision for this in the long term.
Yeah, sure. Thanks. I'll try to make this entertaining, though
Please.
the question where the yield comes from sometimes becomes a little bit less fun. So basically, like what we do, we utilize the well-known carry trade, right, or basis trade. This stuff has been alone in TradFi for like decades, if not hundreds of centuries. And actually, in crypto, it's been known for quite a while. I'd say it emerged with the emergence of the futures. And contrary to the popular opinion, the futures and the perps specifically were not invented by BitMEX back in the day, but by some other practitioners in the space. But they've got popularized by BitMEX definitely back in 2014. So the idea is super simple. You have an underlying asset, like crypto asset, for example, Ether or Bitcoin, and you basically hedge its price movements through perpetual futures or term futures, basically by futures, right? So you don't have price exposure, you have kind of fixed or delta neutral position. Delta neutral means that the value of this position doesn't change, even if the underlying price changes. For example, Bitcoin goes up or down. But at the same time, you're able to monetize these hedges because usually the market structure is as follows. There are not too many stupid people thinking that things gonna go down in crypto, right? Everyone is thinking that everything's going up at any point in time. There are not too many people who sit in short positions in the futures. Usually there are more longs than shorts. Again, I'm simplifying things here a bit, but still. So what that creates is this kind of a bit of a imbalance, and this means that the holders of long positions usually pay a bit to the holders of short positions to make these markets balanced. And that means that if you sit in a short position in the futures, you are getting some kind of a fee, which is basically called the funding rate on the perpetual futures. And that provides good level of yield. And historically, this yield has been really good. So you can take a look at historical data, but this trade was generating easily 20, 30, 40, 50% APYs back in 2021, for example, was pretty popular. I'd say the first product that tried to utilize that was UXD on Solana. It's a stable coin which was hedging positions on a DEX called Mango Markets. Maybe you've heard about it. Didn't end too well. Basically, yeah, you are able to sit in a position where you don't have price risks and at the same time generate good returns on these hedging positions. And actually, if you're holding something which is also you can stake, like Ether, for example, or other assets, you're also getting that staking yield. So that's basically where the yield comes from, right? From staking of the underlying asset and from the funding rates of the futures. So we started back in April 2023, as stated, after USDC DPEG. At the same time, again, I believe everyone have heard about Ethena Labs, started independently around the same time, learned like after 3 months that we exist, them and us. We use a pretty different approach to this, I'd say. The core difference is the two token structure. So what we say is, okay, delta neutral strategies are good. They are good source of yield, and we're printing pretty good results, as you may see. But there are risks involved. And there are a lot of funds, a lot of projects which basically blown up because of these risks. FTX was major one. I believe like 70, 80% of delta neutral funds had massive losses because of that case. But it's not only like exchanges exposure, it's also the volatility of the funding rates and some other aspects. So if you're building a stable coin on top of this, right, not just saying, okay, guys, I'm going to run a delta neutral strategy and pay whatever turns out to be paid. If you actually want to build a stable coin, you need to take those risks away. Because if they materialize, there is a major risk that the peg is not going to hold. So that's why we use the token structure. So the senior token is the stable coin, and the junior token, the second token, is a protection layer. You can think of it as a decentralized, scalable insurance fund for the stablecoin strategy. And basically, it absorbs the risks of losses if, I don't know, Binance blows up, or DEXs, which we trade with, have some issues or hacks, or the funding rates become negative and start to actually not generate yield, but just destroy your peg. And in exchange for holding these risks, the holders of the junior tranche of the junior token, it's called RLP, they get leveraged returns. So basically, we target two types of investors here. Ones who just love the delta neutral yields, which can be pretty good, but they don't want to bear the risks and think, oh, is it gonna blow up? Is it the next Terra Luna? Or like what's going on there? So we build it in a much more transparent and on-chain way, and it's been over-collateralized materially by the protection layer. And the second token is for those who say, okay, whatever, I like farm the yields myself all the way, all the time. I bear the risk, I know what they are. I'm good. I want additional returns. I want built-in leverage, which I can't do myself, um, and just go for high yields. So basically, we target these two different mentalities. To be honest, what we see right now, the second mentality of higher yields is more prevalent. We want to target more traditional capital allocators like family offices, TradFi, etc., with the stable coin because it's a stable coin, right? It's been overprotected. But the DeFi farmers, the yielders, the opportunists, they definitely love to go into this more risky, higher yielding instrument. So that's basically it. I think that highlights the case.
Yeah, that was great. Um, Thanks for breaking that down for us. Even I learned something new here. It's interesting you say most people are interested in the super high or the higher risk RLP yield as opposed to the safer stablecoin yield.
Yeah,
Which makes sense.
I'd say I've seen this in TradFi. So basically, there is such thing as risk perception, right? Risk aversion. In TradFi, there is such thing as risk profiling. So basically, when you go to a financial institution as a client, they'll say, okay, let us ask you a few questions and see how degen you are, basically. Like, are you in to just have like 3-5% returns and be super safe because you need to kind of pay for your own funeral in 50 years? Or you want to just go all in, you only live once and have the most risky investments, you understand how they work. Basically, it creates the risk profile, and it can be like 3, 5, 7 different risk profiles for the clients. There is no such thing in crypto. And everywhere, not only in crypto, but in TradFi, people have this bias. So even in TradFi, instruments which have higher yields, especially fixed ones, usually sell better because the yields are visible. You can say it's 15%, it's 30%, right? You understand what it is. But the risks, they usually are not. or much less visible, and they are much less understandable, and they're much harder to quantify. So this creates some, I'd say, aberrations of perception, and that's why I believe it's a good thing to have the risk segregated, because you can fine tune the instruments to actually find the market for both. But that's what happened before in crypto when people tried to tranche some of the instruments. Basically, everyone was aping into the most yielding tranche, and no one was using the senior one. But I believe that's just an indication of the market maturity, which is actually actively increasing and improving.
Right. Yeah, that makes sense. And I mean, even the senior product here, like I was saying, is I'm seeing a over 20% APY over the past like 30 days on Superform is what we're picking up. And then I see that RLP is about 34%. So like, yeah, I guess significantly higher, but still like, very good yield for the safer option. You compared Resolve to Athena, which I thought was interesting. A lot of people are like, quite familiar with Athena. It's quite popular. I was wondering if you could briefly touch on kind of the differences in the risks between the two, because you have this like tranche model that's like isolating the risk for the stablecoin holders. And yeah, I wonder if you could just briefly touch on like how that's different from how Athena is handling things, if you're able to talk about that.
Yeah, sure. I'll try to be brief here. So basically, I'd say that what we want to do and what we try to achieve is first, again, a stated risk segregation, so that the stablecoin holders are not bothered by the risks of the design, by the risks of the strategy. And second, it's transparency and much more on-chain nature for the assets backing up everything, and more transparency in how this works, what's there, etc. So basically, again, a simple way to think of it is Athena is running a delta neutral strategy. We are running a delta neutral strategy. Athena has an insurance fund. It is about 1% of the TVL, basically. They raised for it separately. It's not too capital efficient. It sits there. It protects the holders of ENA stablecoin, of USD stablecoin, in case something goes wrong. That something can be different, like from taxes, DEXs, to funding rates being negative, to anything else. But basically, that's the amount of exposure which Athena can take, right? If the losses are more than 1% of TVL, or like more than 40 million, I believe they, the peg is gonna be affected, right? There is no way to cover it. Basically, the shortfall gonna go into the stablecoin backing. In our case, this 1% is not 1%. For now, it's like 120%, given the thickness of the protection layer. Actually, it can be much lower. We're provisioning it to be like 25%. So basically, you're saying that as long as there are holders of RLP, the users and holders of the stablecoin of USR are being protected. All of the losses which will be occurring will go into the protection layer, not into the stablecoin. What that gives us is the ability to stack higher yields, to integrate with DEXs much more freely, to integrate with staking restaking solutions. And actually, one of the cool side effects, it was not kind of a side effect, but it turned out to be that we have on-chain backing for the stablecoin. So Athena's backing is all in custody. In our case, the stablecoin is backed by on-chain assets, and you can see it on our dashboard. So the holder can at any point in time go and redeem the stablecoins, understand that it comes from the on-chain source and can be redeemable for understandable assets without relying on any kind of reports or custody, releasing the funds, or what level of safety in this custody is. It's all on-chain and traceable. So I believe these are the key highlights. And basically, it gives like much higher product flexibility. So for example, in our case, since we have two tokens, we can take the volatility of the yields of the stablecoin into the protection layer. So we can, for example, say, okay, the rate for the USR now is 20% fixed until we basically state it's different now. like say for a month, we can say it's fixed 20%. And all the volatility of this rate, because the rates are volatile, I think that's one of the concerns, of major concerns of non-DeFi people, is the volatility of the returns, right? And all this volatility goes into the protection layer. This is a cool feature. I believe we'll see more fixed rates, more fixed terms in DeFi, because that's a way of adoption. If you talk to anyone, even if you talk to BTC holders, right? Imagine like a BTC holder who has like all his BTC and a hard wallet somewhere stuck up deep somewhere, and it says, "Yeah, I want to have some additional yields." And I say, "Hey, there's such cool thing, BTCFi, DeFi, all this." He enters and sees that basically like every block or every day or wherever the yields are different, and also like there's different borrowing rates, there's different yields, and like, hey, what the heck is this? I don't understand what I'm going into. I don't understand what will be the financial outcome of this. um, People are not used to this, so I think that could be a good narrative too.
Thanks so much for breaking that down for us. Yeah, really excited to see some of these fixed yields coming into DeFi and the adoption that's going to bring. Definitely something that we need. Being a space that's so known for the insane volatility. So thank you for trying to bring some stability. I want to turn it over to Jorge to talk about what you are building at Max APY. On your docs, you describe your vaults as high-tech DeFi piggy banks. Anyone who's been following along with the Superform would really appreciate that description. But yeah, I just want to hear from you, like what exactly are these vaults all about? What are you trying to achieve? What types of different strategies are you implementing here? What's going on at Max APY?
Right. So basically, what we're trying to do is make DeFi very simple, and not just like regular DeFi, but like high yield DeFi, right? So right now, like me as a use case, for example, this use case is also kind of like pre-Superform. Superform makes a lot of these things a bit easier as well. But I was, for example, a very heavy user of Beefy, right? Especially during 2019 and 2020, and basically I would spend a lot of time in seeing what to do with my ETH, right, or my stable coins at some point. And now I go into this pool, and now I have a full-time job, I have kids, I have lots of things to do. I cannot be looking at this 24/7, and so now I look at it the next day or in 2 days, and I see that I've been getting a very low yield for the last 8 hours, and so I should have moved before that, but I wasn't able to, right? Um, and basically, what Max APY does is just automate all of this for you, right? Right now, the version that's currently live of Max APY is a simplified version where we basically have an ETH pool or an ETH vault and a USD vault on Ethereum and one on Polygon, and that is kind of like V1. And we're about to launch V2, which is where we integrate Superform. And thanks to the Superform router, what we're going to be able to do is just have one vault for ETH and one for USD. The vault is going to be on Base, but people are going to be able to deposit from any chain using any asset into any of these. And we are going to be moving your ETH and your stable coins cross chain to the best yielding opportunities. So not just on Ethereum or Polygon, but anywhere, right? And so the yield is basically coming from, like, to the question, like the typical question, okay, so but where does the yield come from? Well, the yield is coming from from the underlying strategies, and those might be it might be USR for our stable coins, or it might be Yearn, or it might be Compound, or it might be a Curve Pool, or whatever it may be, right? And so our job is, once we've built all of this, is to kind of like curate the strategies to make sure that we don't get into strategies where there's a lot of risk, right? Where that we get into we only whitelist strategies that are AAA to us. And once that has happened, then you can just deposit and forget about it, right? So far, we have been getting pretty good yields. We have been very consistent on our stablecoin pools, where we have been getting anywhere from 12 to 20 something percent APY. On our ETH vaults, we have been getting even triple digit APYs. So we've been live for like a month, and like half of that time we've been at triple digit APYs. For the ETH vaults, it's a bit tricky still, because on Polygon, there's not many yield opportunities for ETH. There are on Ethereum, but because of the fees, we don't reallocate there as often as we would do on layer twos. So on our ETH vault on Ethereum, you will see sometimes that suddenly the yield will be like single digit for a couple days, right? Before it gets back to maybe the very high yields. And that is because it some time needs to go by until it's worth it really to do that relocation because of gas fees. All of that is going to go away once we integrate Superform and we go cross chain. But that's basically the idea of this. You have ETH and you want to get the best return on your ETH. Just don't break your head. Just go to max APY, deposit, and we take cover of everything else. You want the same for your stable coins. Just go there, deposit, and we'll get you the best yield out there no matter what. And also other things to take into account, like it's not just about moving the funds to the best yielding opportunity in real time by checking literally hundreds of vaults automatically. It's also that we aggregate gas. It's also that we swap efficiently so that you don't have much slippage. It's basically we try to optimize the whole process so that no matter what, you're always going to be getting better yield over the course of a week through max APY than if you would go yourself to the underlying strategies and deposit yourself.
I love it.
May I suppose a hot take here, or actually a question?
Sure.
I may. So, really excited about that, and I believe and the max APY, and I think that basically that's how DeFi should be, right? In
Yeah.
general, the interoperability, the ability to choose the best, to get the best route, to get the best solution, to get the highest APY, etc. And it's very true to the core idea. But I myself feel that DeFi is kind of changing a bit, and we're seeing less DeFi and more, I'd put it, on-chain finance
Yes.
cases or development. And this interoperability, it's more often curbed than not, I'd say. What we see is that the clusters of operators and projects in the space try to create moats. They try to limit access of the competition. They try to basically kind of uh, monetize and verticalize the value extraction in general. And it seems that we're moving to a little bit of a different world. We're not like, okay, so anyone can create a vote, anyone can just jump in, anyone can provide liquidity or run a rule or wherever. It's much more kind of, let's put it, controlled or censored in general. I'm wondering what's your take on these types of developments? Am I wrong here in this perception of DeFi development, or
No, I mean,
what's
I think it's not going one way or the other. It's just that in TradFi, we only had the centralized permissioned option, right? Whereas here, we basically have all options, right? Like for example, if you think you can beat max APY in getting yield on your ETH, hey, like you can go ahead and do it, right? Whereas in TradFi, that's not as easy because you need access to some tools and venues that are only available to institutional players and to professional investors and stuff like that. So you're not even able to try, right? Here you have all options, right? What we try to cater to is those people who are like, hey, I trust that you're gonna just get more APY, or you have proof that you can do that, and I just want to set it and forget it, right? And but you can still go to Superform directly, right, and deposit there in the vaults that you like. And you can also go directly to those underlying vaults without Superform if you would want to, and do it in a bit more cumbersome way, but do it fully manually. And that, it's not just thought for the users to be able to have that all those options. It's also, as you were saying, for the interoperability part. For example, our V1, the way it's built is that we have to integrate every single vault of every single underlying strategy ourselves, right? But by Superform existing, we can forego that, and we can just use their router, we can use their vaults, and it's just so much easier, and it's a win-win because Superform attracts through that a liquidity that otherwise would have gone directly to the underlying vaults and not through Superform, but now it's going through Superform, right? So it gives the users the option, but it also gives the projects the option of, do I need to build all of my infra myself, or can I just laser focus on the value prop and only on that which is my value prop, and and collaborate with others or integrate with others that focus on their value prop, right? And this is just going to spur so much innovation, right? Because when I look back at the other startups that I've done, yes, we have open source, but for everything that is open source, I need to take that repo, I need to take the code and then implement it separately into my code and run it separately and whatnot. And here I can just plug and play, and that allows me to create much smaller startups. That's why we see also that startups in crypto, they're not as big as Web2 startups for the impact that they create. Because at the end of the day, the product is a composition of teams and different protocols that interact with each other.
Hard to argue on that one.
Sure.
Yeah, I love those insights. That's great. And yeah, appreciate the love for Superform. I think you definitely get it, right? Like letting everyone kind of focus on what they do best. We're not trying to reinvent the wheel. There's a lot of people building a lot of cool yield products on chain, and we just want to focus on aggregation, optimization, things like that, because there's super smart people like you guys who are building these exciting strategies and yield products. I wanted to touch on the curation piece because you mentioned that you in max APY you're only including things that you deem to be like triple A quality yield, but then you also mentioned that you're able to get triple digit returns on ETH. So I'm just wondering
Yeah.
how those two things work together. Like how do you curate and still manage to like get incredibly high yields like that?
That was actually an issue for us because we launched, and when we launched we had, I don't know, like 20 something percent yield on ETH, something like that, and then suddenly it went to 600, then 400, then 500. And it was an issue because people would land on our site and they would be like, oh, this is this new protocol, and yeah, of course it's giving like triple digit APY, right? And but it was actually real yield, because the only thing is that when you're looking at so many strategies and so many vaults, there's not a small chance that there's going to be one pool, for example, where during maybe a couple of days there's going to be a lot of demand for liquidity with not enough supply, and so the yield will skyrocket instantly, right? and and the chances are not small that when that goes away, there's another one that has relatively similar situation. And um, this was actually a yearn vault, right, that was giving that APY. But you need to be fast enough in detecting it and in entering it. And since it was on ETH mainnet, you need to have enough money for the gas to be worth it, right? So we do that curation, but still, it can happen that there's a sudden spike in the demand for liquidity with not enough supply, that lasts a few hours, or it lasts maybe a few days, right? We also have other mechanisms that we're implementing now because, for example, we don't just, like on the ETH vault, we don't just work with ETH, or on the USD vault, we don't just work with USDC. We work with all assets that are pegged to the value of ETH or USDC. So on the ETH vault, we'll do strategies that work with ETH, wrapped ETH, Lido, staked ETH, Renzo ETH, Rocket Pool ETH, you name it, right? On the Max USD pool, we will work with USR, we will work with USDT, we will work with DAI, USDS, Go, whatever it is, right? And there, for example, we're now right now we're implementing something to take like to keep a closer look at what happens if one of these depegs, right? So right now, I would say that once we launch the V2, which is going to be in December, with the Superform integration, in terms of performance, there's not a better way of getting performance on your assets than Max APY for sure. And now, what we just need to do is fine tune a bit on the depegging case, and which again, it's not to prevent issues, because right now what we do is we look at the assets and we manually discard strategies that include ETH pegged assets that have not been able to keep a good peg to ETH, but we're just going to be automating that so that we can include them maybe during short periods of time or things like that, so that we can, while keeping to the same risk standards, give even better yield.
And I'm really excited to see what you guys are able to build once you're utilizing Superform for the management of your strategies. So yeah, excited to see what the future holds there, and excited to work together on that. Um, Ivan, I'd love to turn it back to you. We were just kind of talking about future plans here. So, you gave us a great breakdown of Resolve and the delta neutral strategy, how this compares to Athena. I want to hear, like, what's next for you? Like, you've built something really cool, and seems to be working well, providing a lot of yield for your users. But what is next? What is Resolve working towards with this?
Yeah, well, a lot of things I'd say. Well, in general, I'll just prevent some kind of, well, this is an overused word like division, but we still have one. So basically, again, to put things into perspective, we've done structured products. That's basically our bread and butter. We've done some things that haven't been done before in TradFi. We want to propagate that in on-chain finance, in DeFi, and crypto in general. So basically, we definitely see that delta neutral strategy has its merit. It has PMF. We've seen how Athena grown to like 4 billion in TVL over a short period of time. Um, at the same time, understand that basically, like, if you take a look, there is no single bank or broker or financial services provider who basically just runs a single strategy, right? Because not all strategies work best in different market scenarios. And definitely, again, you can't hide an elephant in the room. Delta neutral strategies perform best when the markets are good. Now the markets look good, hence they have the good performance. But definitely, we need to have a broader range of instruments to feel the broad range of interest requirements and different market cycles. Those can be different. Again, that's a whole like industry working on similar things. And TradFi is still a bit too early in crypto for many of those, because the narratives are simpler, the markets are still much less efficient than in TradFi. You can still extract value with the simple strategies, but that will evolve. Our narrative and our vision is to be providing crypto native yields in a scalable manner and the ways to distribute those. So, for example, stablecoin is basically it's a medium of distribution if you think of it. The medium of distribution can be, I don't know, a Telegram app. It can be a neobank application. It can be anything. You need to provide access to new type of assets, exposure to this new type of asset class, which crypto has become, in a crypto native format. So we're not too much of a believers. Again, RWAs are a huge narrative, but we have it in real world, right? It's there. Bringing it on chain is great, but hey, can we make a step further here? Can we bring more crypto native yields? The native yields, I mean, the staking obviously is one. The lending returns in on-chain cases. Again, the funding rates, these are all on-chain generated, and these are all crypto native ones. But they should be scalable. They should have controllable risk pattern, risk exposure. That's what we aim to achieve. So that's kind of the broad thing. Speaking of like the closest implications, first we're expanding to different L2s like based on Arbitrum in the coming week, because for now we're only on Ethereum mainnet. That's where we deployed core product. We'll be expanding into BTC-Fi actively, and we have some edge in this, to be honest. We'll be expanding into some other venues and have, like, to be honest, I believe it's a good thing that we'd love to have the team, which is 2 times larger when we are right now. We're 14 people, just to implement the huge plans which we have in our minds. And it's a long road, and it's something that will be built over years and years, and which has a lot of angles to development. Um, I'd say it's less kind of DeFi only side of things, right? When we basically build a protocol and say, okay, now it can live by itself. Or maybe there will be a V2 or V3 and we'll develop it. We're also super keen on basically bringing in that off-chain liquidity into crypto, right? There's 20 trillion in alternative assets worldwide, which are not being tapped into. But we need to provide TradFi front end, basically. What I mean here is like the counterparties, the regulation, the reporting, everything for those capital allocators to be able to dive in. And at the same time, we want to provide crypto native yields and DeFi composability, transparency on the product side of things to enable that. And that's our broad goal in general.
Oh, sounds wonderful, and I'm glad that you guys are working towards that. And I would love to see those trillions of dollars in capital come on chain. I think that's something that we're all working towards and excited about eventually realizing. We'll wrap it up here pretty soon, but just wanted to give both of you an opportunity. If there's any like final thoughts that you had while you're here, anything that you're particularly excited about, maybe even beyond what you're personally working on, or just anything that you wanted to share in the final minutes here, kind of open it up for you.
Yeah, I'll quickly wrap up here. Just to add a bit, don't want to shill anything or like try to say something like, okay, we're so cool, like only up only, etc. But definitely, like having worked in TradFi for again like more than 10, 12 years, I definitely see how the space evolves. All the talks like, okay, crypto is dead, that happen every like 2 years, maybe 4 years, right when the cycle is down. Now it becomes evident that it's not going anywhere, that we will see much more crypto adoption. With the recent, well, US elections, which are a huge case, I'd say in general, we're seeing that it becomes a new type of an alternative asset class. And at the same time, we're so early in general in terms of development, in terms of available products, in terms of UX, in terms of how this works. Um, I just want to say that it's super exciting to be in the space. And specifically, I believe we highlighted that. I mean, when I worked in a bank, okay, I could do new things on a scale of a country, basically, like being the first to bring some new products here. Still, like the developments were pretty curbed from different angles, and most likely these products have been developed by someone else somewhere. Here we are on the edge of new product developments, on the edge of new narratives, on the edge of new type of infrastructure in the economy. And I don't know anything that can make people, or myself at least, more excited about how many interesting things await us. So I just wanted to kind of highlight that thing, that it's a super great time to be in this industry and build things and see how they unfold and be able to shape. We actually are able to shape how this evolves. It's up to us to make it a great place. I believe that's it. And thanks for having me here today.
Yeah,
Very
and yeah, on my end, I just want to tell you guys to check out Max APY at maxapy.io. Um, we're we're having phenomenal yields. Again, on the Ethereum vaults, sometimes it takes a few days until it relocates, but the average yield we've been getting has been incredible. And keep an eye out on us because in December we'll be launching our V2, which is the cross-chain one, and there the efficiency of getting yield is just going to be incredible. And also, we will decentralize the whole protocol in 2025 by launching a token, and there will be a very good allocation to early adopters. So take a look at it, and if you like it, use it. And if you have any feedback for us, we would love to hear that as well, and make the product better with your feedback. Um, and yeah, and thanks a lot, for organizing this space. It's been phenomenal.
Thanks a lot for joining us. Really appreciate it. Yeah, it was a pleasure to chat with you guys and hear about what you're building and what you're excited about, and get some inspirational words for the future. Really stoked that we're all building in this fascinating industry, and like excited to see where we go from here. And to everyone who is listening, thank you so much for joining us and following along with our journey. I couldn't do it without you. And we're planning on doing these, at least once a month. Where does the yield come from? There's a ton of exciting stuff on Superform, including the two protocols that we talked about today, and a bunch more to share, and a bunch more interesting people with cool perspectives to talk to. So stay tuned and keep posted on that, and we'll see you next time. Thanks so much.